Welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. So far today, we're seeing small gains in European equity markets, trade around half a percentage point higher at this stage. Across the rest of the markets, though, we're seeing relatively small moves. No surprise here, this comes ahead of the US jobs report in an hour or two's time. We do tend to often see this kind of caution in the markets ahead of such important data, and especially when this data comes ahead of a Fed meeting, which is a live Fed meeting, as the Fed would say, when they will be considering potentially raising interest rates, something the market is currently implied odds are at only 20%, which says a lot about what the markets think of the Fed's intentions come the June meeting in 2 weeks' time. The market's currently pricing in around 60% chance that they'll raise in July. I think really what the markets are effectively saying here is not a reflection of what the Fed wants to do or what the US economy is saying right now. I think it's a much bigger reflection of the UK referendum, which takes place just a week after the Fed event. So what the markets are effectively saying is, why would you raise rates at a time when you've got such a huge risk event following shortly after, when you can just wait until July, know what the outcome is then, and then act as you wish. Really, the jobs report today is it's going to be one of these events where we're not necessarily looking for if we get a good report, then that means the Fed hike is definitely on. Like I said, I think the Brexit vote is going to have a far bigger impact than today's jobs report. But if they see a bad report, then that gives the Federal Reserve a domestic excuse for not to hike on this occasion. And I think at this point the markets would really considerably price out the potential for a rate hike in 2 weeks' time. I think you'd see that fall from around 20% now, probably to the high single figures or low double figures, maybe 10 or 11% on the back of this. So it's still going to be an important jobs report. It's going to be potentially a high volatile report, so I think people should take that into consideration today. And it's not just the NFP figures as well. We're expecting around 160,000 jobs to be created, unemployment to fall to 4.9%, but it's also things like the earnings as well. Average hourly earnings expected to rise to remain at around 2.5% on an annual basis, 0.3%. On a month-on-month basis as well. So it's these figures as well I think are going to be very important, although it's always worth noting that the market does initially tend to respond to the non-farm payrolls figure and respond to the earnings data shortly after. So I think this is going to be the main event today. This is what's driving this caution in the market so far today. We've already had a lot of economic data out so far. We've had services PMI data from China and from Europe. The Chinese services PMI slipping to 51.2, a disappointing figure, but really remaining within the broad range that we've seen for the Chinese services PMI data over the course of this year. So not an enormous shock, and I don't think it necessarily tells too pessimistic a story with regards to the services industry, which is growing with importance now. It's now the biggest contributor to Chinese economic output, so it's extremely important, but I don't think there's anything too negative to read into that data. The data from the euro area I think is a little bit more concerning. Really does just highlight how much dependency there still is on Germany as the engine for economic growth in the euro area. French data lingering just above 50, the Italian data falling back into contraction territory. Spain of course continues to perform okay, but I do think really there is still a strong reliance on the German economy to provide economic growth for the region. We've also had the UK data as well, which was surprisingly resilient ahead of the Brexit vote. We've seen a lot of the data from the UK recently performing quite badly ahead of that vote. There's also still a lot of economic data to come from the US, though. We've got things like services PMI, we've got the ISM manufacturing PMI, factory orders. We're going to hear from two different Fed officials today. We've got Brainard and also one other Fed official as well, Mester, I think it is. We've also heard already from Charles Evans, who again has suggested that he does anticipate two rate hikes to come this year if the data continues to perform in line with his personal expectations, which again would suggest that you're expecting one in June or July, and then maybe one after the US election, maybe in December. And we've also got the BQ's oil rig count for those who are focusing on oil. We saw the drawdown in the EIA crude inventory figures yesterday again, which alludes to the fact that we are seeing slower output as a result of the shale industry struggling in the US, but also we are seeing outages in other regions as well, places like Nigeria, Canada experiencing some outages. If we continue to see the oil rig count fall in the US, so that would suggest that this trend is going to continue in the coming months. So we've had plenty of data already to come already today. Big piece of data with the US jobs report coming out shortly, and then there's still more data to come today, so I expect markets to remain quite volatile after the release of this jobs report in about, like I said, about an hour or two's time. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.